Welcome to the Pump and Dump channel for another video. This time talking about some investment ideas in the current space of where we are right now. And obviously the market is in a panic mode, in the crisis mode, because of what happened last week with this SVB bank collapsing or being insolvent. There is, of course, this idea by the Federal Reserve and the FDIC that they will just guarantee all deposits, no matter what the amount is, because they seem to have enough in the FDIC insurance fund. And the Federal Reserve, more importantly, has come out and said that they will allow banks to borrow against the face value of any treasuries, high-grade securities they own, rather than at market values. And that is obviously short-term inflationary. As a consequence, we see the gold price being up today. But yeah, whilst they have insured the system in some way, shape, or form, there is still a substantial amount of doubt, and there's always people who don't get the latest news, who do not know about these measures are being taken. They don't know what they will do. All they know is that there's been a bank run, there's a crisis, and some people are like going crazy today, selling everything, trying to pull their money out of the bank, things like that. Other people are like, in what what would what one would call reckless aggression mode, where they're just buying everything they can get their hands on, bidding for whatever they can get. And we see the reflection, in terms of the general sentiment here in the bond market, the fear index, so to speak. Bond rates of the last couple of days have just absolutely tanked. That's of course a reflection of people rushing into the bonds, driving up the price, and thereby driving down the yield. And so, as a consequence of this here, what that is signaling is that, the fact is that the higher interest rates have led to troubles in the banking system, and the bank has collapsed. And so, even though the Federal Reserve has stated they want interest rates to go higher, and that they're taking these measures to save the banking system, the financial system, so to speak, the market is not necessarily buying and is doubtful. And as a consequence, what we will see is a flight to safety. And with lower interest rates in the market, there is a prevailing theory out there which makes perfect sense to me, is that the market sets rates and the Federal Reserve follows the rates setting by the market, because they was looking at backwards indicator too. So the market is forward looking, so obviously it has to be that way. Makes perfect sense to me, at least. Some people believe the Federal Reserve sets the interest rates, but whatever the case is, rates are going down, and the Federal Reserve, the Fed's funds rate, is higher than that. So if we think these two should be correlated, what we will see is over time is that the rates might go down and the Federal Reserve will follow, because obviously they've pushed things too far. Their efforts have had no effect on inflation. We see that, of course, in terms of the backward-looking measures, because they're looking backwards like 6 months or a year. So they won't see inflation coming down until the end of this year, because they're looking at the past. And the natural gas prices already collapsed, and oil prices down about 50%. And yeah, lots of things are down, but yeah, we see today though that there is this inflow of money into the market. There's of course the fear of contagion spreading. First Republic has collapsed, the share price has collapsed a bit, and that is on the, it says here, despite like government backstop of SVB, but they're only backstopping the depositors, not the investors, not the bondholders, not the shareholders. So the shareholders, if this First Republic is in trouble, are going to get wiped out, is what's happening. And their depositors might be saved, but that's, that's not going to help the First Republic investors. Um, so yeah, the decline, the collapse of SVB was triggered by depositors demanding their cash, their deposits, and SVB's bond portfolio was obviously depressed, and they had to sell at market prices. Federal Reserve has said that they will backstop any treasury related investments that companies have at face value, and so they hope that this will stop the contagion. But like I said, people might not understand that, might not believe it, and so at this point they're panicking. So let's have a think about which companies and sectors will benefit most from a drop in interest rates. Obviously, there is an idea out there that gold, when interest rates are high, that the gold price is not necessarily attractive because there is no yield on gold and such things, and when rates are dropping it becomes more attractive. However, the gold price is relatively high given what production costs are, so why would we be looking at gold? Um, I think the clear thing here to expect is not more QE from the central bank, even though the backstopping of treasuries is short-term inflationary. Over the long term, it should pan out and be neutral. The key thing that's going to come out of this is that the market is going to say we need lower rates, and they're going to bid up bonds to reflect lower rates, and as a consequence, the central bank will follow, and we'll have that kind of quantitative easing, not quantitative easing measure, but just some easing measures of financial conditions being interest rates easing the pressure. So which sector obviously would benefit from that is clearly the real estate industry, because most real estate is based upon interest rates. Like they have an inverse relationship to the interest rates, just like bonds have an inverse relationship to interest rates. So bonds and real estate should obviously do well. And so I've made a list of companies that more or less will benefit from lower interest rates, and here it is. So Medical Properties Trust, I am in the red with this position because I started buying it at I can't remember, at $10 here, and I bought some more here, and I sold a little bit here, and then I bought some more here, and here I didn't want to sell, and then it went down, and I'm in the red, but I bought some more on the way down, all the way from 950 to 850. I've been buying some, and so reason here is, of course, very simple. It's a company that has medical facilities, hospitals and stuff like that, and they rent them out to operators. So they're not necessarily operating in the field, but they're a real estate company who rents it out. They did have some trouble in the last couple of quarters with some tenants being in financial difficulties, but I think they took some measures to address those conditions. And in my opinion, this is really sound. The company is really sound. The management in the conference call is very clear and very convinced of its model, and it makes perfect sense, the model, why it's a good strategy. So I'm very positively inclined towards this company to hold it for the long term, because in the long term we're always going to need hospitals. One could make an argument that we don't need this company to be operating them, but I think it makes perfect sense that the assets will gain value, and this company is solvent, absolutely. So this company should see its assets rise as the interest rates come down, and therefore also the capitalized value of the dividend, which I think is also relatively safe. It could be cut, but it's currently at a 14% yield or so. So if it is cut, it'd still be probably 10% or so, and that's very attractive. 10% or 14% dividend yield is great. It's kind of like a bond, this company, because of the medical facilities, which are in great shape, from what I understand. And so yeah, this is just a company that's been a victim of the recent fear in the market that's led to this V-shaped bottom that probably will rebound back to 10, and then I would say it goes to like 17 or so over 2 years, possibly not, but I think it has a good chance of doing that, and the dividend is real. So yeah, this one looks great. Um, Primary beneficiary, it's not related to the Silicon Bank at all. I think any other banks that they would be dealing with, or that their tenants would be dealing with, are also now in a better financial standing. So I do think that's great. Absolutely great. I don't want to really expand more on it. Next one here, the Walt Disney Company. Uh, yeah, it's been around forever. It's one of those companies that would benefit from a deflationary move where costs of things that they are, um, input costs come down for their productions, and they have a fixed revenue stream on the basis of the streaming subscriptions being a fixed rate, and of course, they can have growing or declining numbers, and that's really difficult to assess. But if interest rates go down, the valuation of of their assets, being intangible assets for the most part, should go up. It's like when you have a deflationary bust, and the QE programs start, and interest rates are low. Fine art is going for crazy amounts, and you know, Walt Disney is kind of a producer of fine art in some way, shape, or form, and yeah, they have a great history. I just don't see how this would not benefit from it. Maybe it does go lower, but I think it's likely it would probably go sideways or much higher. We'll see. Next one, State Street. So this company has most of its business is related to collecting fees on assets under management of investment managers through services provided um, in terms of custody, administration, things like that, accounting, um, keeping the money, keeping, doing the custody. Don't want to get into explaining things that just elaborate too much. So yeah, custody, accounting, administration, all these things. You can read that in prospectus of investment managers funds. Like if you find a US global equities funds from I don't know, Schroders, or who else do they have as clients or have had as clients in the past? I don't know. Um, yeah, I'm trying to think. Probably Deutsche Bank, probably as well. Yeah, so that's where most of their money comes from in inflationary environments. Given that most investments are like in bonds or in real estate, inflationary environments that lead to rising interest rates are negative for the assets under management. But that's, like I said, that's their main business, but only part of their business. They have another part of the business which is structured around the settlement of trades, where they take in money, and then on the basis of taking in the money today and settling 2 days from now. Used to be 3 years ago, and central banks have tried to push towards it becoming 1 day for settlement. But those 2 days that I think they still are on a T+2 basis for settlement. They have the cash in their accounts and they get paid interest. And when interest rates are high, they make a lot of money, because when you're dealing with trillions of dollars and you have them sitting there for 2 days, it brings in quite a lot of interest income. It's great. And so yeah, with interest rates, let's say flatlining, that would become a more representative part of their cash flow, their income. And when interest rates start going down, maybe that does go down then with it. Depends if there's more cash inflows and what that on a net basis, not net basis, really means. But if interest rates are going down, you would expect that assets under management, bonds and real estate funds would go up, and therefore the fees they collect would go up. So it's kind of a hedged investment in both an up and down cycle for interest rates, and over the long term, one would expect that this always would generate gains for investors, as long as the company's managed appropriately and not run into the ground, which is something, a risk that every company has. Next one here, Tag Immobilien AG, shareholding company is what that means, or share. No, what does it mean? Yeah, a shareholding society. This one I bought last week, and it bottomed I think in December last year, but I bought it last week because I'm starting to see this shift in interest rates, policy going from easing, from tightening to easing eventually, and so this is likely in the bottoming phase. And I cannot, of course, say with certainty that this doesn't go down from where it is now, but I do believe that the odds are strongly in favor of this rising, with dropping interest rates leading to a rise in valuation of assets. The company, like other companies, like this leg company recently, this leg company announced that they were not going to be paying a dividend. Tag, I think, got rid of their dividend last year, and so it is to be expected that those measures are taken to shore up the companies in the short term, because they're going through some tough times that you would see at a market bottom. Vonovia here is a bit of trouble because they had some employees do backdoor deals with contractors to steal money basically from the company for work that was not performed. And so yeah, I prefer this tag company. I listened to the conference call, the most recent conference call, um, and I also looked at the presentation. I had a quick look at the balance sheet and the financials, and I came to the conclusion that this is an undervalued company on face value, and I do believe that over time that this one could go back into at least mid-teens. Of course, it was one that went to a euro something in 2008, and then it got to 28 euros or whatever in 2021, and that's back down at 7. So yeah, I think this one looks really good. I like it a lot, and just to be of course reasonable here, and always disclaim that this is not investment advice or recommendations to buy and so on and so forth, but I do own positions in all of these companies. um, Medical Properties Trust I'm down on, because I was overly aggressive and not willing to sell when I should have probably sold some to lighten up. But the other ones I'm all in the green. So yeah, it's the way it is. I like these ones a lot, and I do believe that these will generate outsized returns over the coming year or two. So yeah, I'll leave it at that. So thank you for listening and have a good day.